Okay. Good morning, all of you. So, yesterday I gave you one question. Did you solve? Okay. So, uh, infrastructure capital fund. What is the deduction of discount per year? First year? First year. You did not calculate. See, in the hands of infrastructure, in the hands of infrastructure capital fund. First one is face value. What was the face value per debenture? 1000. Into how many debentures? 10 lakh debentures. Yes or no? So total 100 crores, no? 100 crores less issue price. Issue price was 750 into 10 lakhs. Yes or no? 75 crores. If you reduce this, total discount was 25 crores. This 25 crores will be allowed as deduction under section 36(1)(3)(a). 36(1)(3)(a). On what basis? Pro rata basis. Over the life of the bond. Life of the zero coupon bonds. Therefore, deduction for previous year 24-25. Why 24-25? Because 24-25 was the year in which they were issued. Okay, no? On what date it was issued? 1st June 2024. 1st June 2024 means June to March. How many months? 10 months. So here 25 crores into 10 divided by how much was the life of the bond? 3 years means 36 months. So 10 divided by 36. How much? 694, 44, 444. You got this? Okay. Therefore, deduction for previous year 25, 26 and previous year 26, 27 each. Meaning for each year. Okay, no? 25 CR into 12 months divided by 36 months. Tell me. 33 lakh 333 for each year. Yes or no? And deduction for previous year 27, 28. 25 crores into into 2 months, April and May, because on 1st June 2027 the bonds are going to mature, into 2 months divided by 36 months. How much? 38, 888 or 889, whatever it is. Okay, no? 138, 88, 888. Done, sir? So this was in the hands of Infrastructure Capital Fund. Done? Now in the hands of Mr. Zen. In the hands of Mr. Zen. Maturity of zero coupon bond. This maturity is what? Transfer under section 2 subsection 47. And the zero coupon bonds, it is a capital asset. Okay. And therefore capital gains to be calculated. Now, how to calculate this capital gain? Full value of consideration will be nothing but face value received on maturity. Received on maturity. So face value 1000 rupees into how many bonds? 10,000 bonds. Yes or no? That will be 1 crore, no? 1 crore. Less transfer expense. Transfer expense will be nil. Net consideration will be 1 crore. Less cost of acquisition, which is nothing but issue price paid. How much issue price? 750 into 10,000, 75 lakhs. The balance is 25 lakhs, and this is a taxable LTCG under which section? 112. And why LTCG? Because period of holding which starts from 1st of June 2024 to 31st of May 2027, which is more than 12 months. That's it. So this simple type of question can come in the exam. It can come for MCQs also, case scenario basis, right now? Okay. Now let's move ahead. Should I move ahead? Okay. You all got the same answers now? Okay, very good. Now see, we are going to do section 47. Section 47. Water. Now see, in section 47, no, many transactions we have completed. 2-3 transactions we have already seen in section 47. First transaction, you remember? If you are an individual and if you have transferred your sovereign gold bond by way of maturity, then that maturity of the sovereign gold bond in the hands of individual will be an exempt transfer. Yes or no? First transaction, section 47, done. Second, conversion. Conversion of what? Bonds or debentures into new bonds, new debentures or new shares. Yes or no? That conversion of bonds into new bonds or new shares is also a exempt transfer. Conversion of preference shares into equity shares. Conversion of preference shares into equity shares. That conversion is also an exempt transfer. Yes or no? Now, in section 47 now, there is one transaction which says that if you are an HUF, if you are an, and on the partition of HUF, if the HUF has given its assets to its members, so who is making the transfer? HUF making the transfer, and that transfer is made by HUF to its members on partition. So this transfer is also exempt. This transfer is also exempt. See, I'll take the similar type of example to make you all understand. Okay. So in section number 47, okay, first transaction which we did was a maturity or redemption of what? Sovereign gold bonds in the hands of an individual is equal to what? Exempt transfer under section 47. Therefore, capital gain to be calculated, not to be calculated, not to be calculated. Whatever gain arising will not be taxable only. Okay. On maturity, whatever gain arising will not be taxable. Second, conversion of bonds or debentures into new bonds or debentures or shares is also exempt transfer under section 47. Therefore, here also the capital gain, whatever capital gain is there, will not be taxable. Yes or no? Third one, conversion of preference shares into equity shares. Even this transfer is an exempt transfer under section 47. Therefore, capital gain will not be taxable here also. Done, no? Now the fourth transaction which I just now told you was what? Transfer of what? Transfer of any capital asset. Transfer of any capital asset by HUF to its members on its partition is also an exempt transfer under section 47, and therefore capital gain will not be taxable in the hands of HUF. Understanding now? Now we will discuss this transaction first. You have to be a little bit careful. If you will understand this entire transaction, no, so whatever things whatever other exempt transfers which we are going to discuss, they will become more easier for you. Okay, no? So pay attention. If there is one HUF. Now this HUF had acquired a capital asset. Okay. Now this capital asset was acquired on 23rd July. No, 23rd September 2004. Meaning in which previous year? Previous year 4-5. Okay. And the actual cost of that asset for HUF, actual cost was, let's say, actual cost was 1 lakh only. So at how much cost HUF acquired the asset? 1 lakh. When HUF acquired the asset? 23rd September 2004, meaning 24-25, right now? Then 2004-5. Now this capital asset was transferred to any member, on partition of HUF. Now this transfer happened on 11th February 2015. 11th February 2015, meaning which previous year? 14-15. Yes or no? At that time, the fair market value of that asset was, example, 2,10,000. So what was the fair market value of that asset? 2,10,000. And before doing this, some cost of improvement was also incurred. Okay. Cost of improvement amounting to rupees 20,000 was also incurred by HUF, and this was incurred in previous year, let's say previous year 11-12. Possible or not possible? Now tell me, how much is the gain arising in the hands of HUF? How much is the gain arising? There is an appreciation of how much? 2,10,000 minus, so you will minus 20,000 also, no? So how much? So there is an appreciation of 90,000 in the value, because from 1 lakh the value of the asset has become 2,10,000, and also 20,000 cost of improvement was also incurred. Yes or no? So total appreciation in the value is 90,000. Now see, this 90,000 is not realized in the hands of HUF, because the HUF is not transferring the asset and getting 2,10,000. It is just an appreciation which happened in the hands of HUF while the HUF was holding that asset. So value of the asset was 1 lakh when HUF bought it. HUF also incurred 20,000 rupees cost of improvement. Now HUF was holding this asset. It kept on holding till what time? Till the time HUF did not transfer the asset to member. Till that time, the total value appreciation was 1 lakh to 2,10,000, meaning 90,000, because 20,000 cost of improvement was also incurred. Yes or no? So total appreciation in the value is 90,000, and that 90,000 is the appreciation in the value of the asset when the HUF was holding that asset. Understanding? This should be taxable in the hands of HUF. But since this 90,000 gain will not be realized in the hands of HUF, why? Because HUF is not transferring for a consideration of 2,10,000. On partition it is transferred to member, and from member the HUF is not going to get what? 2,10,000. Hence this 90,000 is not realized. This 90,000 gain is not coming in the pocket of HUF. So why to charge this 90,000 in the hands of HUF? So in the previous year 14-15, when this partition took place and the asset was transferred by the HUF to the member, in that year this 90,000 should not be taxable in the hands of HUF. This 90,000 should not be taxable in the hands of. So therefore, in previous year 14-15, the transfer by HUF to member will be treated as what? Exempt transfer. Under which section? 47. Therefore, capital gain of rupees 90,000 will not be taxable in the hands of HUF. Now tell me, who will realize this gain? This 90,000 gain will come in whose pocket? In the future, whenever the member will sell the asset, now the asset belongs to the member, no? Now whenever in the future, when the member will sell the asset, this 90,000 gain will be realized in the hands of that member. It should be taxable in the hands of member. It should not be taxable in the hands of HUF because it is not realized and not coming in the pocket of HUF. So now who is having the asset? Member is having the asset. Member sold. Can I say member sold this capital asset? Member sold this capital asset on 21st of October 2025, meaning previous year 25, 26. Yes or no? In the previous year 25, 26. Member sold this capital asset. Done, sir? And member sold this capital asset for rupees. Selling price. Let's say selling price was 5 lakhs. Selling price was 5 lakhs. And before selling, member also incurred some cost of improvement. For example, member incurred a cost of improvement of 50,000 and he incurred the cost of improvement in the previous year 21, 22. Possible? Now tell me, when the assets value was 2,10,000, when the assets value was, that time member acquired this asset for the first time. When the member became the property for the first time? In 2014-15. In 2000, on partition, member became the owner of the property for the first time in 2014-15. That time the value of the asset was, and from that, now today the value is total appreciation 2 lakh? No, 2 lakh 40. Why? Because member also incurred cost of improvement of 50,000. Yes or no? So now tell me, this entire appreciation happened when member was holding the asset. Don't you think when the member will sell the asset for 5 lakhs, this appreciation will come in the pocket of member? And also this appreciation will also come in the pocket of member. So both the appreciations, meaning 3 lakh 30,000. Total appreciation 3 lakh 30,000 will now be realized by member when the member will sell the asset in the future. So this entire appreciation should be taxable in the hands of member. How it will be taxable? Simple. Take the cost of previous owner as the cost of acquisition in the hands of member while calculating his capital gain. This is what section 49(1) says. So as per section 49(1), as per section, there are certain modes of acquisition which are prescribed. So if the assessee has acquired the capital asset by way of any of the modes prescribed under section 49(1), then cost to the previous owner will be deemed to be the cost in the hands of the assessee. What did I say? If the assessee, in our case, who is the assessee? So if the assessee has acquired the capital asset by way of modes, he is not acquiring the asset by purchasing the asset, yes or no? But he is acquiring the asset by way of modes which are prescribed under section 49(1). So what are the modes which are prescribed under section 49(1)? On partition of HUF, by way of gift, by way of will, by way of inheritance, by way of revocable or irrevocable transfer, yes or no? By way of transactions referred in section 47, clause 4, clause 5. Likewise, there are many modes which are prescribed in section 49(1). If the assessee becomes the owner of the capital asset, if the assessee has acquired the capital asset by way of these modes which are prescribed in section 49(1), then the cost of acquisition of this asset in the hands of assessee will be nothing but cost to the previous owner. Cost to the and any cost of improvement incurred by the previous owner will also be deemed to be the cost in the hands of the assessee. So even this cost will be deemed to be the cost in the hands of assessee, and even cost of improvement incurred by the previous owner will also be deemed to be the cost in the hands of assessee. So that this 90,000 gain which now the assessee is realizing should be taxed in the hands of assessee. Understanding? So now who is the assessee for us? Come on, tell me. Okay, so now can I say therefore in previous year 25, 26 transfer by whom? By member. Is it an exempt transfer? No, member is selling the asset. Transfer means he is selling. Sale. Transfer means sale. Sale by member. Is it an exempt transfer? No, it is a taxable transfer. So now at the time of making the taxable transfer, yes or no? Capital gain, how much? 2,40,000 plus the earlier gain of 90,000 which was exempt in the hands of HUF. This entire gain should be taxable in the hands of HUF. Yes or no? So when the member is making the taxable transfer, okay, no? When the member is making a taxable transfer, that time the capital gain will be calculated. Now how this capital gain will be calculated? Come on, let's see. How this capital gain will be calculated? Computation of capital gain. Simple. How to calculate this capital gain? First we will take full value of consideration, nothing but selling price. At what price member sold? 5 lakhs minus transfer expense. Any transfer expense incurred by the member? The answer is no. So net consideration will be 5 lakhs. Net consideration will be 5 lakh minus what? Cost of acquisition, which the member will reduce. Now this cost of acquisition will be taken under section 49(1) because member has acquired the asset by way of mode, which is specified under section 49(1) on partition of HUF. Partition of HUF is also a mode specified under section 49(1). Yes or no? So cost of acquisition in under section 49(1) will be 1 lakh. Okay, no? That 1 lakh we are going to reduce. And also the cost of improvement will be reduced. Cost of improvement by member will also be allowed as a deduction, and cost of improvement by previous owner HUF will also be reduced as a deduction. Why? Because cost of improvement incurred by the member is also treated as cost under section 49(1). Understanding? If this cost of improvement is not allowed, then gain of 1,10,000 will be taxable, whereas the gain was only 90,000. So that 90,000 gain should be taxable. To do that, any cost of improvement incurred by the previous owner should also be allowed as a deduction in the hands of member. Yes or no? Assessee. So hence this cost of improvement which is incurred by the HUF will also be deemed to be the cost, and any cost of acquisition incurred by the previous owner will also be treated as your cost. Yes or no? So how much cost of improvement member incurred? 50,000. And how much cost of improvement HUF incurred? 20,000. Both you reduce. Okay. How much you are getting? 3,30,000. This will be your capital gain. But this will be short term or long term? Depends on the. So now we are saying that this is taxable what? Long term capital gain under section 112. But why we are saying that it is a long term gain? For that we are checking the period of holding. So now tell me, period of holding you will check from 11 December 2015 to 21st October 2025. If you are checking this period of holding, check this period of holding if only this much gain is taxable. The gain for earlier period is also taxable in your hands, no? So why don't you include the period of holding of the previous owner in your hands. So the period of holding of the capital asset in the hands of assessee will also include the period of holding of the previous owner. So whenever 49(1) gets applied, period of holding of the previous owner is also included in the period of holding of the assessee. So period of holding will not be taken from here to here. No. It will be wrong. Period of holding will be taken from here to here. This is the correct period of holding. So tell me, period of holding 11th December, 11th February 2015 to 21st October 2025. 21st October 2025. So this is the period of holding of assessee only. We are not supposed to take this only. We are supposed to take the period of holding in the hands of previous owner also. We have to include it. So instead of starting from 11th of February 15, we'll start from 23rd of September 2004. Yes or no? To 21st October 2025. So 23rd September 2004 to 21st October 2025. Now this period of holding is more than what? 24 months. Therefore the asset was long term, hence the long term capital gain is calculated. And we have not taken any indexation. Why? Because the member has transferred the capital asset on. Tell me, 21st October 2025, on or after 23rd July 2024. Done, sir? Easy or difficult? Easy only, no? Will you be able to solve a question like this? Perfect. Write down a question. Fast. Kishan HUF. Acquired one capital asset, acquired a building on 9909, 9 September 2009 for rupees 10 lakhs. For rupees 10 lakhs. It incurred a cost of rupees 2 lakhs Okay, do one thing. Kishan HUF acquired a building. On which date? Make it 9 September 99. 9 September 99. Done? So instead of 2009, it is 9 September 99. Okay? 9 September 99 at a cost of rupees 10 lakhs. It also incurred a cost of rupees 2 lakhs on 15th March 2000. 15th March 2000. 15th March 2000 on extension of that building full stop, and rupees 3 lakhs on 14 July 2003. 14 July 2003 on addition of another floor on that building Done? In the next line write down. This building was given to its member Mr. Radhe Mohan on its partition when the FMV was 30 lakhs. When the FMV was 30 lakhs. Full stop. Radhe Mohan also incurred a cost of rupees 5 lakhs when it was given to Radhe Mohan on partition. Date I have not given, no? So write down, what did you write? It was given to its member Mr. Radhe Mohan on its partition on 15 November 2006. 15 November 2006. Yes or no? When the fair market value was 30 lakhs. Yes or no? Next, what have you written? Radhe Mohan also incurred a cost of rupees 5 lakhs on improvements of this building. In the year 2012-13. In the year 2012-13. Full stop. Further, on 11th June 2014, Radhe Mohan entered into an agreement to sell this building to Mr. Ganesh for a consideration of rupees 50 lakhs. For a consideration of rupees 50 lakhs and received an advance of rupees 1 lakh from Ganesh. Received an advance of rupees 1 lakh from Mr. Ganesh. Full stop. Mr. Ganesh could not pay the balance amount on time and the sale agreement was cancelled. And Mr. Radhe Mohan forfeited this advance. Okay. Full stop. This building was finally sold by Mr. Radhe Mohan to Mr. Mukund. To Mr. Mukund. Full stop. Date of sale agreement. Date of sale agreement. 4th July 2025. Finally sold to Mr. Mukund, no? For rupees 1 crore. For rupees 1 crore. Now, next line, date of sale agreement, 4th July 2025, SDV was 1 crore 20 lakhs. SDV was 1 crore 20 lakhs. Date of registration, comma, date of registration, 2nd December 2025, SDV 1 crore 25 lakhs. Okay, full stop. Mr. Mukund has paid an advance of rupees 10 lakhs at the time of entering into sale agreement. At the time of entering into sale agreement, by way of cross check. Okay. Next line, FMV of this building, FMV of this building as on 1st April 2001 was 20 lakhs. 2001, yes. FMV of this building as on 1st April 2001 was how much? 20 lakhs. Full stop. Next line, compute capital gains, determine its nature, and also the tax payable on such. Also the tax payable on such capital gain. Mark this question important. Okay. Now try to exploit all the things which I have taught you so far in this same question. Now this question does not have only one concept. This question has multiple concepts. So you'll get stuck at some or the other point. Okay. So if you remember and recollect the things which I have taught you, you'll not go wrong. But sometimes some place you can go wrong. Okay, no? So I've also exploited section 47, then section 51, advance money received and forfeited. That concept also is there. Then also the section 50C I have also exploited. Okay. So all these things are there in this question. Now see, since you have written the question, okay, now you know what things are happening when. So decode this question and try this question. Come on, first. I'm giving you 10 minutes. Then I'm going to solve this question. 10 minutes only, huh? Do it fast. Maitri, Shweta, are you all there? Did you write the question? Okay. Solve the question, huh? 10 minutes. Do it fast and give me the answer quickly. You will understand the question if I will solve it. Sure? Okay. See, I'm solving that question. Huh? Previous year, when HUF gave that asset to member, 15th November, meaning previous year, 6, 7, assessment year 7, 8. Okay. In this previous year, HUF, Kishan HUF, no? Kishan HUF transferred the building to its member Mr. Radhe Mohan on its partition, which is an exempt transfer under section 47. Therefore, capital gain will not arise in the hands of Kishan HUF. Capital gain not taxable in the hands of Kishan HUF. Okay. Did you understand this? Now, next transfer is taking place. See, it was, now the asset is with the member, no? Mr. Radhe Mohan. Radhe Mohan tried to sell it to Mr. Ganesh. In which year? In which year? 2014-15. So previous year 2014-15, assessment year 15-16. Okay. Some advance money received and forfeited by Mr. Radhe Mohan. How much was that? Rupees 1 lakh. Yes or no? From Mr. Ganesh, to whom building was not transferred as he could not pay what? The balance consideration and sale agreement was cancelled. So that time he tried to sell the asset to Mr. Ganesh, but since Ganesh could not pay the balance consideration, sale agreement was cancelled. So advance money received rupees 1 lakh was forfeited. Now tell me, any advance money received and forfeited prior to 1st April 2014 will be adjusted as per section 51 when the asset will be actually transferred. But this advance money was received and forfeited on which date? 11th of June 2014, meaning on or after 1st April 2014, this advance money was received and forfeited. So this advance money will not be adjusted under section 51 because in that year it was already taxed as income under the head IFOS. So advance money received and forfeited by Mr. Radhemohan, 1 lakh from Mr. Ganesh, to whom building was not transferred as he could not pay. The balance consideration and sale agreement was cancelled. Therefore, such advance received and forfeited was taxed under the head IFOS in previous year 14-15, that is assessment year 15-16, and not to be adjusted under section 51 out of cost of acquisition of such asset, such building. At the time of its actual transfer. Tell me, have you all understood this much? Everyone, have you all understood this much? Now what will happen? 14-15 discussion done. 6-7 discussion done. Now we are coming in the year, previous year 25-26. That is assessment year 26-27. Building was finally transferred by Mr. Radhemohan to Mr. Madan. Yes or no? Mukund. Oh, sorry, Mukund. Huh? Mukund. Okay. Therefore, capital gain will be calculated. Now this capital gain calculation, first of all we'll take full value of consideration. For that we'll make working note. Working note number 1. Minus any transfer expense was there? No? You're very lucky that I did not give that transfer expense. Then you will get net consideration. Minus what? Cost of acquisition. For that we'll make note 2. Okay. Minus cost of improvement. For that we'll make working note 3. Okay. After having all these things, the capital gain will be there. That capital gain will be short term or long term. That we are supposed to determine. Now which all amounts you will put here? That is the most important thing. Shall we? So first, what will be the full value of consideration? The property was sold for 1 crore. Selling price is 1 crore. Yes or no? So working note number 1. Working note number 1. In this working note we are determining what? Full value of consideration. So the sale consideration is how much? 1 crore. Is this 1 crore less than stamp duty value? Sir, stamp duty value as on date of sale agreement is also given. And sir, sale agreement as on the date of registration is also given. Yes or no? What was as on the date of sale agreement? 1 crore 20 lakhs. And as on the date of registration it was? So we usually take the date of registration only. Yes or no? But we can take the stamp duty value as on the date of sale agreement also. If as on the date of sale agreement was made on 4th of July 2025, on or before this date, on or before, consideration or any part thereof is paid by way of prescribed mode. See, consideration was 1 crore. Out of that, 10 lakh rupees advance is paid on the date of sale agreement. Yes or no? So we can take 1 crore 20 lakhs. But we could have taken only if that 10 lakh would have been paid by way of prescribed mode. But it was paid through cross check. And by the way, cross check is not a prescribed mode. So we cannot take this stamp duty value. Okay. And we'll take this stamp duty value. Yes or no? Now tell me, is the stamp duty value 1 crore 25 lakhs? Yes. What is the sale consideration? 1 crore. Therefore, difference between stamp duty value and sale consideration is how much? 1 crore 25 lakhs minus 1 crore. The difference is 25 lakhs. Yes or no? Is this difference more than 10% of sale consideration, which is 10 lakhs? How did you get 10 lakh? 10% of 1 crore. Yes or no? Is this 25 lakh rupees difference is more than 10 lakh? Yes. Therefore, full value of consideration under section 50C will be equal to 1 crore 25 lakh. That is the stamp duty value. Now this amount we are supposed to put in the solution. You are very lucky that I did not give story number 3. Yesterday I told 3 stories also, no? First story, you accept. So you accept. This is the stamp duty value. If I would have said that no, the assessee did not accept, Mr. Radhe Mohan did not accept the stamp duty value, he made an application to the AO that the fair market value is less than stamp duty value. AO made the reference to VO. VO also determined the value. VO's value determined was less than the stamp duty value. Then the stamp duty value cannot be taken. Then you'll have to take the VO's value. If VO's value is higher than sale consideration, then VO's value will be taken as full value of consideration. If the sale consideration is higher than VO's value, then the sale consideration will be taken as full value of consideration. Do you remember all those things? You just thank me that I did not give that information. Otherwise it would have been more. But this also has put you in trouble, see? So everyone got this? How did we arrive at 1 crore 25 lakhs? So now in my solution, full value of consideration I will take 1 crore 25 lakhs. Any transfer expense? No. So the net consideration will be 1 crore 25 lakhs only. Yes or no? Now out of this 1 crore 25 lakhs, I will reduce cost of acquisition. Now let's go to working note 2. Working note 2 is for cost of improvement. Done, no sir? Cost of acquisition. Now see, cost of acquisition in the hands of Kishan HUF, in the hands of Kishan HUF, who is a previous owner. Yes or no? Previous owner will be deemed to be the cost in the hands of assessee. But first of all, we'll have to determine what is the cost of acquisition in the hands of Kishan HUF. Now tell me, Kishan HUF acquired the asset on what date? 9/9/99. First line, hello, prior to 1st April 2001. For how much? And incurred some cost of improvements also prior to 1st April 2001. Any cost of improvement incurred prior to 1st April 2001 is not allowed as a deduction, even if it is incurred by you or it is incurred by the previous owner. Will not be allowed as a deduction, because you will get the option under section 55 to B to take what? Fair market value as on 1st April 2001 as cost of acquisition. So here tell me, A, what is the actual cost? Actual cost was 10 lakhs. Yes or no? This 10 lakh can be taken as cost of acquisition. Kishan HUF acquired for 10 lakh. Lucky that I did not say that at the time of purchasing 1% brokerage was also paid. If 1% brokerage was paid, then it would have been added to this actual cost. Yes or no? But not given, then this actual cost is this much only. Yes or no? How much? B. B what? Fair market value as on 1st April 2001 for buildings which are acquired prior to 1st April 2001. The fair market value can be taken as cost of acquisition. But this fair market value cannot be more than the stamp duty value as on 1st April 2001. Say thank you. I did not give that stamp duty value also. So stamp duty value not available as on 1st April 2001. Yes or no? So this fair market value can be taken. But if the stamp duty value would have been there, then I would have restricted my fair market value to the extent of that stamp duty value. Yes or no? So tell me, what was the fair market value? In the last line of the question I have given 20 lakhs. So 10 lakh can be taken or 20 lakh can be taken, whichever is higher. So therefore 20 lakhs. Therefore cost of acquisition of Kishan HUF, who was the previous owner of this building, is how much rupees? 20 lakhs. And now this same amount shall be what? Deemed to be cost of acquisition in the hands of Mr. Radhe Mohan. Under section 49(1), since he acquired the building from Kishan HUF on its partition, that is a mode specified under section 49(1). So it was a mode specified under section 49(1). Partition of HUF is a mode specified under section 49(1). And on the partition, if it was acquired from HUF, so that same amount which was the cost in the hands of previous owner, HUF, will be treated as cost in the hands of assessee, Mr. Radhe Mohan. Did you understand this? Yes or no? So now what is the cost of acquisition? 20 lakhs. The cost of acquisition in the hands of previous owner will be deemed to be the cost in the hands of assessee. And what was the cost of acquisition in the hands of previous owner? 20 lakhs. That we have already determined. Yes or no? How did we determine this 20 lakhs? 10 lakh actual cost or fair market value as on 1st April 2001, whichever is higher. Understood or not? So now here we are going to reduce 20 lakhs. Done, sir? Now cost of improvement also we are supposed to take. Done, sir? So working note 3. Cost of improvement. Now see, cost of improvement is incurred by Kishan HUF, who is a previous owner. Yes or no? In which year? In 99, 2000. Yes or no? What was the date? 15/3/2000, meaning 99/2000. So this cost of improvement amounting to rupees 2 lakhs was incurred in which year? 99/2000, meaning prior to 1st April 2001 will be ignored, since it was incurred prior to 1st April 2001. Any cost of improvement incurred by previous owner, okay, again it was incurred by previous owner Kishan HUF in 2003-4 also. See, 3-4 no, date 14th July 2003, 14th July 2003, meaning 3-4 also some cost of improvement was incurred. How much? That 3 lakh. That 3 lakh will be ignored or will be considered? Will be considered. It will be considered and shall also be treated as cost in the hands of Mr. Radhe Mohan. As per which section? As per section 49(1). So as per 49(1), cost of acquisition incurred by the previous owner will be treated as your cost, and any cost of improvement also incurred by previous owner will be taken as your cost, provided it was incurred on or after 1st April 2001. Understanding? Did you understand this much? Now some cost of improvement was incurred by the previous owner, and some cost of improvement was also incurred by Mr. Radhe Mohan. How much? 5 lakhs. Yes or no? And this was incurred by Radhe Mohan in which year? In previous year? 12-13. In the previous year? 12-13. 5 lakh rupees. Getting my point? Will this be considered or this will be ignored? This will be considered. Your cost of improvement will be allowed as a deduction to you. Simple. It will be considered. So therefore, total cost of improvement is equal to 3 lakhs plus 5 lakhs. Total is 8 lakhs. Now this cost of improvement we are supposed to reduce 8 lakhs. So in my solution here I'll write 8 lakhs. Reduce this. 90. This is your capital gain. Short term or long term? Taxable LTCG under section 112. Yes or no? And why this is LTCG? Because you took the period of holding from which date? When the asset became your property? No, when it became the property of the previous owner. From that date you will check the period of holding. Yes or no? So Kishan HUF took the property in 9999. From that date to when did you transfer to Mr. Mukund? 4th July. That is the date of sale agreement. What is the date of registration? To 12/25, meaning the date of registration is the date on which the asset is transferred. Yes or no? So 2/12, meaning 1/12, 2025. And this period is more than how many months? 24 months. Okay. And here you will write period of holding of Kishan HUF also included in period of holding of Mr. Radhe Mohan. RM means Radhe Mohan. Since asset was acquired, building was acquired through mode specified under section 49(1). So through a mode specified under section 49(1), the building was acquired. Hence, the period of holding of the previous owner also included in the period of holding of the assessee. This you have to write. Okay. So tell me, did you come to know that the gain is a long-term gain? How did you come to know that the period of holding was taken from this date to this date, which is more than 24 months? And why you are not taking from 6/7? Asset was given in 6/7, no? So you should have taken from 6/7. Why you did not take from 6/7? You will have to give the reason that you are taking from 99/2000 to 25/26. You have included the period of holding of the previous owner also. Why? Because the asset was acquired through a mode specified under section 49(1). So whenever the asset is acquired through a mode under section 49(1), in that case, the period of holding of the previous owner is also included. That we have included. Hence, we are seeing from 99 to 25/26. Understood? Understood? So this will be the question. See, capital gain. If such type of question will come now, definitely 100% it will be for minimum 8 marks. So they are telling you to calculate capital gain. So in different years, they are not telling you to calculate the capital gain for which year. So what we did, we first talked about previous year 6/7. Then we talked about 14/15. And see, this cost we have not adjusted from, this advance we have not adjusted under section 51. If that advance money was received and forfeited prior to 1st April 2014, then the cost of acquisition here would not have been 20 lakhs. It would have been 20 lakhs minus that 1 lakh, which was received and forfeited by Radhe Mohan. So any advance money received and forfeited by the assessee prior to 1st April 2014 will be adjusted out of the cost. So that time the cost would not have been 20 lakh, we would have reduced this 1 lakh. But why are we not reducing here? Simple, we are taking the full cost. Why we are not adjusting that 1 lakh rupees advance from here? Because the advance money was received and forfeited by Radhe Mohan only, but it was on or after 1st April 2014, it was already taxed under the head IFOS in that year, so it is not to be adjusted under section 51. Whatever cost is there, full cost we are going to take. Understanding? That I have already written above. Okay. Now in 25/26, when Radhe Mohan finally sold the asset to Mukund, that time the capital gain will be calculated. And to calculate that capital gain, full value of consideration, they will make you very uncomfortable in taking these amounts. Many of you could not even start the solution. So this kind of question comes in the exam, it will be for minimum 8 marks. Or a case scenario can be given like this. And out of this case scenario, 2 marks small MCQs can be asked. Understanding or not? Now they are telling you to calculate only capital gain or the nature of gain. We have already calculated. The nature of gain is long term. See, and why we took long term? Why we took long term? Because the period of holding from this date to this date. They want to make sure that whether you know this concept or not, including the period of holding of the previous owner in your period of holding, you know this or not. Hence they are asking you nature of the gain also. Short term or long term. Don't forget to write that. And if you are writing long term, why are you writing long term? Because you took this period of holding. Why did you take this period of holding? Because the asset was acquired through a mode specified under section 49(1), and whenever this happens, the period of holding of the previous owner is also included in the period of holding of the assessee. That we did. And hence, because of this period of holding, the asset becomes long term. And hence the resulting gain is long term gain. And one more thing they are asking you. Also calculate the tax liability now. How will you calculate the tax liability? Come on, tell me. So now I am going to calculate. This is very important calculation, huh? If you remember this, I had told you. I don't know whether you will be able to do it or not. Computation of tax on LTCG under which section? 112. So first we are going to take LTCG without indexation. Yes or no? As computed. As computed above. How much was that LTCG? 97 lakhs. On that, the tax is to be calculated at the rate of 12.5%. Why are you doing this? Why are you doing this? Tell me first. Because the asset is a immovable property. Assessee is a resident individual, Mr. Radhe Mohan. Asset is an immovable property which was acquired prior to 23rd July 24 and which is transferred on or after 23rd July 2024. So for this asset, whatever capital gain will be calculated without indexation. On that you are supposed to pay how much tax? 12.5%. Yes or no? And then you are given an option to pay 20% on the long term gain with indexation. Now you will calculate the capital gain with indexation also. Understanding? But first of all, 12.5% will be how much? 12 lakh? 12,000? Can I say this is my tax 1? Yes or no? Tax 1 is how much? 12 lakh 12,500. Done, sir. Now I will calculate the long-term capital gain with indexation. Can you calculate? 3,75,640. No. LTCG with indexation we are going to calculate. Okay. So tell me, what will be the full value of consideration? As above. 1 crore 25 lakhs. 1 crore 25 lakhs. Minus what will be the transfer expense? Nil. Transfer expense will be nil. Then what will be the net consideration? 1 crore 25 lakhs. Yes or no, sir? And out of this net consideration, now I will reduce index cost of acquisition. Now please pay attention. Index cost of acquisition was 20 lakhs. Cost of acquisition was 20 lakhs into CII of year of transfer. So when Mr. Radhe Mohan transferred? When Mr. Radhe Mohan transferred? 25-26. Can you see the CII of 25-26? It is 376 into 376. Now divide by CII of year of acquisition. So now you will take acquisition by Radhe Mohan or acquisition by HUF. You should get the indexation from that time only, no? Understanding? But that is not the case. See, law says that the indexation will be available with effect from the previous year in which the assessee acquired the capital asset for the first time. So when the assessee acquired the capital asset for the first time on partition in 2006-7, yes or no? So as per the language of the law, the indexation should be available from 6-7. But there is a very famous case law of Bombay High Court, Manjula Ben Jayantilal Shah versus CIT. What is that case law name? Manjula Ben Jayantilal Shah. Manjula Ben Shah versus CIT. This is a case of Bombay High Court. In this case, it was decided that the indexation benefit should be available with effect from the previous year in which the previous owner acquired the capital asset for the first time, assuming that the assessee also acquired the capital asset for the first time, that time only. Because since the cost of acquisition of the previous owner is taken as your cost, the gain for his period is also taxable in your hands, then why not the indexation for that period should be given to you? Yes or no? So here it is very, very important that what CII you are dividing. You can divide the CII of previous year 6-7, that is correct as per law. That is correct as per law. Or you can divide the CII of that previous year in which the previous owner acquired for the first time. That is also correct, but as per the Bombay High Court judgment. So, which CII you are going to take here? Bombay High Court. And you will have to just write a note for that. That we have taken the indexation from the previous year in which the asset was first acquired by the previous owner as per the decision of the Honorable High Court, Bombay High Court, in the case of Manjula Ben Shah. Understanding what I am trying to tell you? Now when when previous owner acquired? 99-2000. Tell me what is the CII of that year? Not given. CII of 2001-2 is the first year CII. Yes or no? And that you are supposed to take. Understanding? Because anyways you are going to take the fair market value as on 1st April 2001 as cost. So indexation should be available from 1-2 onwards. So any previous year prior to that, CII will not be available. So you are supposed to take the CII of 2001-2 only. 100 base year CII. Getting my point? So here you are going to write what? 100. And mark this point important, 100. Okay. How much? 75 lakh? 20,000. And you are going to write down below this. Indexation with effect from previous year in which capital asset was first acquired. First acquired by whom? By previous owner. And this you are doing as per law? No. As per judgment of Honorable Bombay High Court. In the case of Manjula Ben Shah. Versus CIT. If you would not have done this, you could have taken the CII of 6-7 also. The year in which the asset was first held by Radhe Mohan on partition. Then it was as per law. So as per law, that was also correct. So you should have given a note that indexation benefit is given with effect from the previous year in which the assessee has acquired the capital asset for the first time. Yes or no? And we have not taken it from the beginning. But that is illogical thing. Why illogical? Because bloody, if the cost of the previous owner is taken as your cost, the gain for his period is also taxable in your hands. His period of holding you are taking as a period of holding in your hands, then why not the indexation for his period of holding? Yes or no? So indexation for his period of holding should also be given to you, which was not given. So the department and assessee fought for that. And department and assessee fought. Bombay High Court gave the judgment in the favor of assessee, Manjula Ben Shah. That assessee should be getting the benefit of what? Indexation, not for his period of holding only. It should be given for the period of holding of the previous owner also, because the gain for his period of holding is also getting taxable in your hands. So the indexation for his period of holding should also be given to you, assuming that the asset was first held by you with effect from that date on which it was acquired by the previous owner. Understanding or not? Or only saying yes, 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 let it be? Understood? Sure? Okay, so this cost of acquisition you have done. Now cost of improvement, sir. Cost of improvement, index cost of improvement. One index cost of improvement or two index cost of improvement? Two. Because one cost of improvement was 3 lakhs. Yes or no? Incurred in which year? 3 lakhs. And second cost of improvement of 5 lakh incurred in 12-13. So cost of improvement index, first of all 3 lakhs into transfer year CII 376 divided by improvement year CII. This 3 lakh was incurred in which year? 3-4. So what is the CII of 3-4? 109. Write down how much is the amount? Huh? How come 1 lakh? 10,34,863. And one more cost of improvement was there, no? 5 lakhs into transfer year CII. Transfer was made in 25-26. So CII is 376 divided by improvement. This improvement was done in which year? 12-13. 12-13. What is the CII? 200. Everyone got this? 9,43,000. Add both of them. 9,40,000. 9,40,000. Add both of them. 74,863. Now do one thing. 1 crore 25 lakhs minus 75 lakh 20 minus this. 13 lakh, 30 lakhs. 1. This is the long-term gain with indexation. On this, now we are going to calculate tax at the rate of 20% on LTCG without indexation. Tell me how much? 6,01,027. This is the tax. Yes or no? Can I say that this is my tax 2? Tax 1 I have already calculated. Tax on LTCG without indexation. Yes or no? And this is tax 2. Tax on LTCG with indexation. Yes or no? So this is B and this is A. Tax 1, tax 2. Therefore, tax on LTCG under section 112, which is what? Lower of tax 1 and tax 2. How much tax you would like to pay? 6,01,027. How was the question? Tell me. You just thank the God that I don't set the papers, huh? If I start setting the papers now, capital gain questions will be like this only in the exam. Done, sir? Sure, sir? Okay. So we are in section number 47. We are in section number 47. First transaction, exempt transfer. Second transaction, exempt transfer. Third transaction, exempt transfer. And fourth transaction, exempt transfer. Fourth transaction you have done. Did you understand the entire calculation? Okay. Now, if this type of transaction is there in the question, okay, so it will not be for only the exempt transfer. It will be for the assessee who has acquired the asset by way of this transaction. For that assessee, now later on whenever the asset he will sell, how the capital gain will be calculated. For that 49(1) will be applicable. So whenever you do this transaction number 4, you also refer what? 49(1), also refer 49(1). So with this transaction, refer 49(1) also. This transaction is applicable for HUF and 49(1) will be applicable for member. Understanding? Transaction was there for HUF. For HUF, it is an exempt transfer. No capital gain will arise. But sir, for the member, when the member will sell the asset in the future, member will calculate the capital gain. So what will be the cost in the hands of member? 49(1). Cost to previous owner. And any cost of improvement incurred by the previous owner will also be allowed as your cost. Yes or no? Provided it is incurred on or after 1st April 2001. Any period of holding of the capital asset in the hands of previous owner will also be included in the period of holding of the member. Yes or no? And indexation, if it is there, indexation, there are two possibilities. Number one, indexation for your period also can come. If you are following the strict language of the law, or if you are following the judgment of the Bombay High Court, then the indexation will come from beginning and not for your period of holding only. Understanding? So whenever 49(1) applies, you have to remember these 3 or 4 things. Number one, cost to previous owner will become my cost. Assessee will say, cost to previous owner will become my cost. Number 2, cost of improvement incurred by the previous owner will also become my cost as per section 49(1). Yes or no? Number 3, period of holding of the previous owner will also be included in my period of holding. And number 4, indexation for my period of holding if I am following the strict language of law. And indexation for the period of holding of the previous owner might also be taken by me if I follow the judgment of Bombay High Court in the case of Manjula Ben Shah. These things constant. Whenever 49(1) will be there, these things are constant. You have to remember these things. Will you? Everyone? Yes or no? So this is the end of your question and the solution. See how the solution was there. Okay. Now we'll take a small break. After the break we are meeting and we are going to continue from here. Other transactions of section 47 will be over. Then this part will also be over. Okay. We are going to solve all the questions today, and today this chapter will be over. Okay. See you in some time.